around. Okay.
Walk around. Go ahead.
Yeah, so real pleasure to be here. We have three things that I'd like to speak about today. The first is my new book, Foreign Exchange, Practical Asset Pricing and Macroeconomic Theory. This just came out in February of this year. The second is Volatility, Practical Options Theory. I wrote this book in 2018. And the third is, I've been asked to speak a little bit about my journey from, a seat not too dissimilar to several people in the room as a undergraduate student at university through to working on the trading floor at several major financial institutions. So I'll try and cover all of those things today. Let's start with the new book. So what does this book do? I think the way to think about this book is it is a practitioner's book, right? You are here and you study economics or finance, and you come across lots of topics that are relevant to foreign exchange. And I've listed the main drivers over here, things like purchasing power parity and real exchange rates, covered interest rate parity, inflation, balance of payment accounts, and of course, this what I think is the most important of all of these, the risk premium. But you typically come across these in sort of a disparate way. You can read a 600-page international economics textbook and kind of get these ideas. And then you have to read a separate book on to understand the risk premium, which will be in a finance book, and that will be typically focused on the equity markets. And so what this book tries to do is put all of those concepts in one place. But the other thing and this is the thing that I really want to emphasize, is that if you are a practitioner, you work in an environment where time constraints mean that simplicity and intuition are of far greater value than the formalism of a mathematical or an economic model. You need to have rules of thumb. You need to have things that you can think about within minutes so that you can actually go and trade, right? And what this book does is perhaps it sacrifices some of the rigor that one of the really big thick textbooks might have, but it gives you what you need to make decisions quickly. And so that's the focus of it. I think the other thing that I would say is that in the practitioner world, there's a certain language that's used to describe a lot of concepts, and in the academic world, there's a certain language that's described to use a lot of very similar concepts or overlapping concepts, and there isn't really a bridge between those two. So I've tried to use my background, which, as Pallavi mentioned, some academia, some industry, to try and do that and try and fill that gap. So this is the product of many years of kind of thinking about things, and I hope you find it useful. So look, I can't go through the whole book in such a short time, but what I want to do is really kind of give you a flavor for the type of approach that's taken in the book, so that you can then go away and have a look, and if it's useful, and try and implement some of the ideas yourselves. So I picked out what I think are the most interesting parts of foreign exchange trading, and for me, it's this concept of the risk premium. In the finance literature, people talk about, there's a lot of papers about how the risk premium is the most, the dominant component of asset price movements. I think that's very much true in foreign exchange. It's not written about quite so much in FX markets, but that's kind of where I focus on. Okay, so question one, what is the risk premium? So let me try and explain it with a little, let's do a little game. So Pallavi, I'm going to pick on you for this game, right? So we're going to do a bet, okay? And the bet is going to be, we're going to bet on an umbrella. That's going to be the stake. And it's just a coin. So we flip a coin. It's a fair coin. If it lands on heads, you give me an umbrella. And if it lands on tails, I'll give you an umbrella, right? Sounds like a fair bet. Symmetric at least, we're perfectly happy, we go and do that bet. Now let's change this bet slightly, right? So I turn on the radio, and the forecaster says that tomorrow there's a 50% probability of sunshine and a 50% probability of rain. So I say, oh, I know someone who likes to bet umbrellas at 50-50 odds, it's Pallavi. So I phone up Pallavi and I say, let's do this bet again. But this time, if it rains, you give me an umbrella, and if it's sunny, I'm going to give you an umbrella. All of a sudden, Pallavi's not so happy about that bet anymore. But what's changed? The odds are exactly the same. You know, an actuary would price this bet exactly the same. But what I've changed here is this very important thing. It's the correlation between the payoff and the state of the world. You don't want to be short an umbrella when it's raining, right? And this kind of idea comes from the economic theory. You know, you think about utility functions and trying to smooth your consumption over time. When it rains, you're unhappy. The umbrella offsets that, makes you happy. When it's sunny, you're happy anyway. You don't need anything to offset that. So that's the kind of microeconomic foundation of this idea. But that's where the risk premium comes from. So now, how do we trade? So Pallavi says, no, I'm not going to trade this at 50-50. So how do we trade? Well, the way I clearly have to sweeten the deal for you, right? And the way that I do that is I say, okay, if it's sunny, I'm going to give you 2 umbrellas. And if it rains, you still give me only 1 umbrella, right? So now you think, okay, well, if it rains, you'll be unhappy. You'll get wet. You'll be unhappy. But if it's sunny, at least you've got double the payoff, and that compensates you to some extent. You can, you know, save one of those umbrellas for a future rainy day. You can sell one of them and do something with them. And so you trade. So now an actuary comes along and says, okay, well, this bet is trading at 2 umbrellas upside to 1 umbrella downside. And so then they say, okay, what is the umbrella market implied probability of rain? It's not 50-50, it's now 2/3, it's 66% because of the 2-to-1 ratio of the payouts. Right? And so this difference between the objective probability of rain, the 50%, and the market, the umbrella market implied probability of rain, that is the 66%, that is what we call the risk premium. Right? So now this is all about umbrellas, but the key point is that investors, they put more probability weight on bad states of the world, right? And assets that do badly in those bad states of the world, like the pandemic, a rainy day, those assets therefore end up trading at a discount because we've got more probability weight on them. So that's the concept of a risk premium, and hopefully this umbrella example will stick in your minds. And you know, that's kind of the core of it. Now, how does this apply in asset markets and in currencies? I'm going to do one more. I'm going to do one more example for you. So, you know, I made this statement earlier that I thought that the risk premium is the major component of currency movements and asset price movements. And it's so important that, you know, when you learn about foreign exchange and you learn about some of the variables, you know, we spend all this time analyzing, you know, what's inflation going to be and what's, you know, interest rates going to be and, you know, what's the real exchange rate and so on, right? And you spend so much time on those. But what I want to kind of show you is that because of this risk premium, actually currency markets and all asset markets, they can trade far, far, far away from their fundamentals, right? Prices can move, they often just don't even care what the fundamentals are, right? And that is something that you need to know as a trader. And that is something that's kind of covered in the academic literature. So let's think of this example. So we've got a bookmaker, and the bookmaker is taking bets on the election between the Economic Growth Party, the EGP, and the Economic Decimation Party, the EDP. Okay, the bookmaker doesn't know what odds to set. So instead of setting odds, they say, okay, everyone come into my shop and put your bets down. And what the bookmaker finds is he gets $70 of bets on the Economic Decimation Party and $30 of bets on the Economic Growth Party. So he says, okay, well, this is easy, right? All I do is if I set my odds that I set 70% probability, the $70 goes to 70% probability for the EDP winning and a 30% probability for the EGP winning. If that's where I set my probabilities, then my odds that I set are 1 over that. And now I'm perfectly hedged. Whatever happens, I'm fine, right? Because if you know, I received $100 from the punters, and if the EDP win, well, I'm going to pay out 70 times 1.42. And if the EDP win, I'm going to pay out, EGP win, I'm going to pay out 30 times 3.33. In both cases, I'm going to pay out $100. But what's the key here? So this all sounds a bit contrived so far, right? But what's the key here? I haven't told you what the actual odds are for this election. They could be 50-50, they could be 90-10, it doesn't matter. All that matters is the flows of capital. The fact is 70% of people put down their money on the Economic Decimation Party and 30% put their money on the Economic Growth Party. And that's what determined the market price. That's what determined the odds, right? So that's huge. That's a huge thing, right? Like forget doing the analysis on who, the polls. That's all the bookmaker needed to know. You just need to know the flows of capital. Now, you might ask why? Why did so many more people put the money on EDP? It's because, they're hedging themselves. If they win the election and decimate the economy, well, you want to hedge that risk, so you put more money. You put more money. And so that is the example. Now, this is the point. So in red, I put the point. The objective probability of who will win the election does not matter. And that sort of implies that currency valuation doesn't matter. Right? It doesn't matter what the growth rate is in Europe versus the US or something like that. If there's a risk premium, the price of the euro can diverge far from what those fundamentals would tell you. Okay, so let me try and convince you of that a little bit more with some charts. So this chart here, this is the currency behavior in one of the most extreme volatility events that we've had, or certainly that I've had in my career. This is COVID, right? So the blue line that's ducking down here, that's the S&P 500 into sort of February and March of 2020, right? And then I've shown, I've shown the green line is the Mexican peso. So I just put that up as a representative for emerging market currency. The red line is this sort of red line here is the Australian dollar, right? And then these are what I would call the risky assets. And then up here, I have the safe assets, the Swiss and the yen, which are considered traditional safe currencies. And what you can see is the risky assets, they're risky, right? So the S&P goes down, the Mexican peso goes down, the Aussie goes down. But things like the yen and the Swiss and the dollar, remember this is all against the dollar, these are actually doing very well in that time. In fact, the Swiss strengthened and the yen strengthened against the dollar. And it did very well in that initial period, and those currencies kind of held their value over the period. Now, if you think about what happened here, like COVID, there was no divergence, right? COVID was a global shock. Every global economy went down together. All interest rates across all countries were going down together. There's very little divergence. But the fact that Mexican peso, or other, Chinese yuan, you can think of, the South African rand, the ruble, the Turkish lira, they were all collapsing. And at the time, the Swiss, the yen, the dollar were all strengthening. What that tells me is that if, the Mexican peso was ever trading at fundamentally the fair value, at its fair value, like it had the same kind of real purchasing power as the dollar, I should never allow that to happen. If that ever happened, I should buy the dollar and sell the Mexican peso, right? Because the dollar is going to give me this rainy day hedge. The dollar is the umbrella in this case. So is the Swiss, so is the yen. And so the fact that we get this kind of behavior in currencies means that we need to price that in ex ante into those currencies. So I've got a few more things I wanted to mention about the book. So what I did in the book is, again, I want people to read this book and then trade foreign exchange without having to do too much more, right? You should have, you should understand that in this sort of state of the economy, this is how currencies are going to behave. And so the book contains, I've got 7 different kind of examples of scenarios that might occur. And the book kind of goes through all of those and I kind of suggest to people who trade foreign exchange to kind of almost memorize some of those examples because they're going to be useful. But I was hoping to get through 2, but I think I'm just going to have time to do 1. I'm going to do this one here. When I wrote the book, I called it Table Tantrums because I wrote the book before this kind of environment that we're in now of fast rising real US interest rates and a Federal Reserve that's reacting very aggressively at this stage to inflation. When I was writing the book, the talk was about the Fed being behind the curve on raising interest rates. And so I wrote the book with the examples of, the taper tantrums of 2013 post the global financial crisis when, the Fed first said that they were going to taper. But essentially, it's the same example that we have now, a central bank that is raising interest rates fast, and that is causing worsening risk sentiment. People are getting scared about what's going to happen as a result of this, and that's going to cause risk premiums to increase. And so I'm just going to run you through how markets are going to behave or are behaving and why they're behaving the way they are. So I'm going to start with the S&P 500, and then I'm going to show you the currencies and how they kind of track and are related to the S&P 500. Okay, so Again, I'm whizzing through this. I appreciate that, and some of the concepts might not be familiar, but I just want you to get an idea of, the way that the book tries to explain these, the kind of big picture ideas, and then you can go through the book and have a look. So let's suppose that, in 1 year we expect that the S&P 500 will be at 38.50 each. Right now, remember we need a risk premium. Right, that chart showed you that in the rainy state of the world, the S&P 500 goes down. So investors put more weight in the asset market. They'll put more weight on that bad state of the world, and so their pricing for the S&P 500 will be a lot lower than where they objectively expect the S&P 500 to be. So in this example, I've put in a 6% risk premium. This is kind of consistent with history. So the 1 year forward price of the S&P 500 is 36.27, at 6% discount to the actual objective expectation. And then there's a relationship between the spot price and the forward price, right? There's no arbitrage relationship. Some people may have come across that in your courses, but essentially you take the difference between the dividend yield and the interest rate. And if the higher the dividend yield, relative to the interest rate, the more downward sloping this line is. So in this example, I've got 3% dividend yield, I've got 1% interest rate, and so the spot price is about 2% higher than the forward price. Okay, now what happens? The Fed come out and they say we're going to hike interest rates by 1%, right? So what happens in the market? Well, first of all, an interest rate hike of 1% is going to lower your expectation for the S&P 500 in 1 year. Why? Well, several reasons. One, you might expect that the high interest rates might cause companies to be able to struggle a little bit in their production. That you might lower your forecast for what the S&P is worth on that. It can also raise the value of the dollar. Ultimately, when you trade stocks, it's like an exchange rate. You're trading dollars for stocks, right? And you're sort of saying that the purchasing power of the dollar might increase in a year's time. You're going to lower inflation, so the nominal value of companies will go down. And so then I've lowered my 1 year expectation from 38.50, and that's come down to 38.13, just done a 1% lowering there. The second thing is that people are getting nervous, right? Credit spreads are widening. People are thinking, I need a bigger discount to own the S&P 500 than I did before. I'm worrying about that rainy day more. I did price in a 66% probability for the rainy day. Now I'm going to price in a 75% probability for a rainy day, something like that. And so you price in a bigger discount. So then that forward needs to trade now at, I put in an 8% discount relative to the 1 year expectation. And then finally, go back to that no arbitrage relationship. That blue curve that relates the forward to the spot, that has to be flatter now because US interest rates are higher. And remember, the slope of that is the difference between the dividend yield and the interest rate, so that's flatter. And the flattening of that curve also further lowers the nominal value of the S&P today. And so what happens is that in the end, on the back of this, the S&P 500 falls 4%, of which 2% comes from the higher risk premium, 1% comes from the lower future expectation for the S&P, and 1% comes from the flattening of the forward curve. Okay, so that's how the stock market is, and that's kind of how it's behaving, right? This is a 1% move. We've had much more than a 1%. The stock market's down 20% this year. We've had a 4% move in yields pretty much, and so these numbers are kind of ballpark reflective of what's actually happening. Now, how does it work in currencies? Well, currencies are very, very similar, right? So remember, I showed you that chart of the Mexican peso over COVID, and it looked very similar to what the S&P did, right? And so it makes sense that the pricing of the Mexican peso should be very similar to how we price equities, and that's what the book highlights. So let's do that again. So I've done MEX dollar, which is a little bit confusing because I just wanted to keep the dollar on the same side of it. Most people will be thinking about dollar MEX as opposed to MEX dollar, but let's just go with that. So my 1 year expectation for the Mexican peso was 0.04852. And then I have a risk premium, a discount here between the spot and the forward. So I put in 4% risk premium. Apologies, that shouldn't say expected, that should say forward, 1 year forward, that should say. And then just like, you have the difference between dividends and the interest rate, in currencies, you have a relationship called covered interest rate parity. You take the foreign interest rate and the domestic interest rate, and you look at the difference between those, and that gives you the steepness of the line that goes from the forward price to the spot price. So in this case, Mexican interest rates 8%, US interest rates are 1%. So that line is 7% steep, and so I get to a price of 0.05 today. Now let's do the same thing. So the Fed unexpectedly hikes by 1%. Well, one, I'm going to lower my expectation of what the Mex dollar exchange rate is going to be in 1 year. I'm going to increase my risk premium. So I've now gone from a 4% risk premium to a 6% risk premium. And then I've also flattened this curve. This curve had a steepness of 7%, but now it's only a 6% steepness with high US interest rates. And so the combined impact of all of that is that the MEX falls by 4%. And so you can see that, the way that equities behave, the way that currencies behave, it's all very closely related. And that's kind of where it's, these relationships come from. That's why you see markets behave in such correlated ways. Same drivers ultimately that drive the currency markets and the equity markets. Now, for something like the Swiss, it's the opposite effect. Remember, the Swiss we said was a safe haven, right? So the risk premium is negative in Swiss. I don't need a discount to own the Swiss. I pay a premium to own the Swiss. We know in COVID, Swiss strengthened. We know in bad states of the world, Swiss strengthens. Why? Well, I don't know. But we know that Switzerland's got 150 years history of 2% stable inflation through world wars and so on. And so you can imagine why investors would like to own the Swiss in times like these. So here, for the Swiss, we've had the opposite, right? The 1 year Swiss exchange rate is 1.01, but the forward is actually above my expectation. I pay a premium to own the Swiss. And then when the Fed hiked the interest rate, that premium, that negative 0.5% premium, that becomes bigger, that goes to 1%. And so when you run through all of the same logic and all of those same steps that we just did, you find that the net result in Swiss is it only falls by 1.5%, right? So we had equities falling by 4%, we had Mexico falling by 4%, but the Swiss were only falling by 1.5%. The reason for that is that the risk premium effect goes in the opposite direction to this interest rate hike. Now our next topic is going to be the new, my previous volatility. You think about being a volatility trader. It's super important. Do I want to own volatility to protect myself in Swiss or MEX? Or if they were the same price, I would definitely own it in MEX because you can see the risk premium effect is added to the interest rate effect, and that's how you drive volatility. Great. So yeah, apologies. I know I've kind of skimmed through that quite quickly, and these ideas are not easy to understand. But I hope that gives you a flavor for how the book tries to treat these things. That my message in the book is like memorize 7 of these charts, and then you've kind of covered pretty much every scenario that I've seen anyway in my kind of 12, 13 years of trading foreign exchange. So I'll just quickly pause there before we go on to the new book, the previous book. Okay. So volatility. So my new book is about macro and FX, but my career has been spent as a volatility trader. Flavi mentioned in the introduction, I traded options at Barclays, at PIMCO, and at Goldman Sachs. And I want to give you, an introduction to options. And I say this to my colleagues, I've been trading these things. I've written a book about these things. I am still fascinated by these things. I think these are some of the most incredibly interesting products and useful products for someone in their financial career, whether you go into foreign exchange or into something else. Options are going to be a key thing for you to understand. So let's go through this quickly. So this is a basic of an option structure. Many of you may have seen this before, but let's just focus on the black one. Essentially, what it is this: you get this hockey stick type of payoff, right? So essentially, a call option gives me the right to buy. In this case, I've got euro dollars. My buy euros at 137. And so, if the euro is worth more than 137, say if it's worth 140, well, I buy them at 137. I sell them at 140, and I get a $3 million payout in this example. And so you can see why you get that shape. If the euro is weaker, then I just don't buy the euros. Hence, it's called an option. So that's the shape of the payout that I get. What I want to convince you of is that this options, these are, when you look at this diagram, you think, okay, well, this is like a bet on the euro going up. What I want to convince you of is that that's not true. That options are a bet on volatility and volatility. Right, and I'm going to try and show you that. So first of all, let me show you the straddle. So in the interbank market, this is the standard contract that trades, right? It's just buying a call and buying a put off the same strike. So you get this V-shaped symmetrical profile. Now you can see here straight away that this is a bet only on volatility, right? Because if I have this thing in my portfolio, I don't care if spot goes up by 3 big figures or spot goes down by 3 big figures. My payoff is the same. All I care about is that it moves. I need it to move one way or the other. So now let me show you that that's true for a call and a put as well. Or I'll show you for the call anyway. So let's suppose I buy the call option in my portfolio, and now I do something called a delta hedge. And this is a big part of options trading, this delta hedging. People who've studied the Black-Scholes-Merton model will be familiar with this, this concept of the delta. So what's my delta hedge? Well, we know that, let's try and do this, right? So delta, so I buy, in this case, I've shown 200 million euros payout of the call option. And then I sold 100 million euros of spot in the market at the same rate. So the spot is trading at 137, and I sell 200 million euros of spot. Now you can see that this is the payout for a spot trade. If spot goes up, I'm losing money. It's a sold spot. So if it goes up, I'm losing money. If spot goes down, I'm making money. So I put these two things together, and what do I get? I get the sum of those two things, and that is the straddle. And we already agreed a minute ago that the straddle is a bet only on volatility. So what you can see is that it doesn't matter if I have a call option in my portfolio. Once I do this delta hedge, I have a bet on volatility. And essentially, what Black-Scholes-Merton did was they made this argument. Like here, this argument holds initially, right? I have this symmetrical payout, but let's say spot moves here, then at this point, my payout's not symmetric anymore because, if it goes back, I lose money, and if it goes up, I make money. Black-Scholes-Merton tells you how to do this continuously in time and in spot space, but that's the kind of the central idea. So options are bets on volatility. So I want to give you some, a couple more quick bits, and these are things that I recommend for people to memorize and if they want to trade options. So the first is, volatility. What is it? Well, again, kind of intuitively understand it. It's how much spot can move. But formally, what is it? Well, volatility is just the annualized standard deviation of the probability density function of the spot rate. In highly volatile markets, think COVID, think right after the Ukraine invasion, this distribution is getting wider. And so the price of these options is going up. And calm markets, you think about, let's say, broadly that period from say 2017, 2018, 2019, the kind of Goldilocks economies, low and stable inflation, generally good state of the world, geopolitically. Macron had just beat Le Pen in the election, and a lot of the, things have calmed down. This thing would be a lot narrower. So just think when people say applied volatility, it's just a standard deviation of this. That puts in this way some more complicated concepts around skewness, associated, things like that. And then I go through them all in the book. Essentially, that's kind of what you need to take away. And now, this is, let me give you an example. So now let's just apply some basic, kind of your, first year statistics on options. Well, we know that the one standard deviation of a probability distribution contains 68% of the probability. So what's that saying? So let's say you come to the market, and the market maker says that, the 1 year option implied volatility is 10%. All that's saying is that 68% of the probability is contained within 10% of the spot distribution. So if the euro is trading at 100, right, what we're saying is that there's a 68% chance that euro will be between 0.9 and 1.1 1 year from now. That's all it means. And so now that you know that, you can kind of trade options. Let's say you thought that the probability of euro being in that range was higher than 68%, you would just go and sell options. And if it was lower, then you would buy options. And so you're kind of there, right? You don't need that much more than that, right? It's simple standard deviations. And I think, there are not many books that kind of make that point. If you think about courses on this, and I did these courses, and I spent a lot of time confused in financial maths classes, but you have like a 12 lecture course, right? And it will typically start with, binomial model, you do some stochastic calculus, you do some, Ito's lemma, Gazanov theorem, change the measure. 10 lectures later, you get to the Black-Scholes model, then you start differentiating the Black-Scholes model for another 2 lectures, and then eventually you get the Greeks. when you do all that, you almost can't see the wood from the tree sometimes. And I think the difference between, with this book is it tries to put it in a trader, tries to put you in an option trader's mindset. We don't have time to go and sit and think about, the Greeks in too much detail. We need quick, intuitive way to think about it. So that's what the book does. Now, this book does actually go into the Black-Scholes column, but it does it only in chapter 9. So it's kind of backwards relative to this. And the only reason I did that is because I wanted to convince you, the readers, that the book is rigorous. What you learn in the first 9 chapters is consistent with the Black-Scholes model. You just don't need to know the Black-Scholes model to trade options to I would say to the highest level. Yeah, I think I'm kind of pushing time, so I think I won't have time to do